Good morning, good evening, good afternoon, wherever you are, whoever you are. Welcome to the Building on Bitcoin Virtual Summit. Everyone, my name is Zero, and I'm from the Zero Authority DAO, built on stacks, secured by Bitcoin. Today, we have a great lineup of Bitcoin builders who are pushing us into the future of the Bitcoin economy. Banks are collapsing, Bitcoin isn't. For the next session, Kyle Ellicott, partner of the Bitcoin Frontier Fund, is going to moderate a conversation with Akshat Vidya, Chinde Su, and Caitlin Long. And they're going to give us their insights and share their thoughts on macro, the Fed, SEC, and ultimately how Bitcoin is becoming the anchor in the chaotic world that we see today. I'm going to pass it over to Kyle. Great to see everyone. Thanks for having me. Excited for this talk.
Thank you so much, Zero. All right, let's ruffle some feathers, everybody. We got a lot to talk about. Throwing out a quick stat, the FDIC closed 465 banks from 2008 to 2012. Just a data point to get us all excited about what we're going to talk about today. Here we are in another moment, similar, possibly. We've got a shaky infrastructure from a financial side across the world, not just in the US, but globally. We have banks very notable, whether that be Silicon Valley Bank, that be Signature Bank. We saw notable bank closures in the beginning of 2023, which could lead us to another moment. It could not. But that said, we also have Operation Chokepoint, something that is continually talked about. Not everyone may know exactly what it is, and we talk a lot about it. Caitlin, can you give us an overview of what Operation Chokepoint 2.0 is and how that's really impacting this financial infrastructure that we have?
Yes. Okay. Operation Chokepoint is an actual Obama administration operation jointly conducted by the Department of Justice and the FDIC. Started with the payday lenders, ended up including adult entertainment, gaming, firearms manufacturers, oil and gas, those kinds of parade of politically incorrect industries. And it hit 30 different industries before it was shut down in 2017. So over about a 4-year period, give or take, under the then chairman of the FDIC, who is again now the chairman of the FDIC. The FDIC decided to politicize the banking industry, and on both sides of the political aisle, once it became publicly known, which, by the way, it happened through litigation. The bank regulators, the FDIC specifically, denied that it was happening, and it wasn't until a lawsuit got to discovery that it was proven that it was happening, and then the hammer came down on the FDIC. Now, Operation Chokepoint 2.0 started in January, and unfortunately, Custodia Bank was at the beginning of it. And since then, it's crystal clear that there has been a debanking of the crypto industry, and it is now repeating and moving beyond just one industry, just like it did in 1.0. And the next industry that it's moving to, apparently, is fintech.
Which has an impact on all of us. I mean, I don't think any of us would have looked back last year and said, hey, Operation Chokepoint 2.0 is coming in January. Everything we know about financial, well, I might not have. Caitlin did. But Caitlin, I mean, looking back a year ago, did you see this? Is this something you saw forward, and what were you doing to prepare for this?
I did not foresee that it was coming specifically in January of 2023, but the whole reason why I worked on Custodia, and even before that, helped the state of Wyoming create this new charter, was to address a problem that entrepreneurs in this space brought to the Wyoming legislature when they asked, what can Wyoming do to help this industry create a legal and regulatory framework to recognize it. Keep in mind, back in 2017, a single state hadn't recognized a Bitcoin or other crypto assets as property. This is basic stuff, and it had to get done in order to create a roadmap for a judge to handle a legal dispute. If you don't know what Bitcoin is under the law, that becomes an attack vector on Bitcoin. This is one of the very strong thoughts that Trace Mayer back then, one of the OGs in Bitcoin, had, that we have to make it backwards compatible with the legal system so that judges don't become attack vectors on our stack. And the Wyoming got that started. But entrepreneurs back then were saying the biggest issue they were having was that they were losing their bank accounts. And we see that in the winters. We saw it in 2013, 2014, back when this is when Coinbase really made its name. It was competing alongside BitPay and some others back then that don't exist today for leadership in the exchange world. And why is it that Coinbase became what it is today? It's because it had durable banking relationships and others did not. And so the punchline, unfortunately, is that I always knew this was an attack vector. Ryan Selkis at Messari has been saying this for a while, that the single point of failure in the industry is the US dollar banking on and off ramps. And I think he's right. I've been saying he's right. So that's why I rolled up my sleeves and took on what is actually a much harder problem, banking, than dealing in the securities issue, which a lot of others are dealing with. Absolutely, that's a problem too. But I always knew Ryan was right, that the moment they brought back Operation Chokepoint, that this industry, this single point of failure issue was going to become a problem. Now, does Bitcoin itself give a damn about banking? No. And that's one of the greatest things about it. And, you know, obviously a lot of activity is going to be offshore. And so obviously they can't kill Bitcoin, but they certainly can harm adoption by shutting off the on-off ramps.
Right. And also potentially the development, right, of some of these new applications, you know, coming after the world of fintech, for instance. That's a big market on the venture side, a big market on the development side, a big market on the usability side as well, which could change a lot for all of us, both as developers and users as well. Chente, a question for you. Similarly, I mean, I know, like Caitlin, you probably saw something like this coming. You have a background in traditional finance, now in the industry of Web3. Knowing that this could be a potential, what led you to double down on Alex, on the massive amounts of upgrades that Alex has had, including, congratulations on the launch of your bridge mainnet today, knowing that this was a problem? What led you and the team to double down as a developer in this?
Right. I think if we zoom out a little bit and look at what really shook the world this time, this particular regional crisis, is that if you look at the SVB and Signature Bank, they have combined assets of 300 billion, and that's like 1.2% of the total 300 trillion of US banking system. But yet, you know, the banking system is so fragile that, you know, it could lead to a systemic risk. And if FDIC this time did not pay off this uninsured, you know, deposit, I think that's really the question that we have been asking ourselves, that the banking system is so fragile. Now, to be clear, I think Caitlin and then Akshay would agree with me that, you know, SVB and Signature Bank, they are really the victim of these rapid deposit withdrawals. So there were no greedy bankers. You can say they're, you know, incapable bankers, that they failed to hedge the interest rate risk, but they did not invest in subprime loans. And SVB particularly is due to also the mismanagement of the interest rate risk, as well as their concentrated, you know, sector of their depositors. And we all thought, you know, we came from traditional finance, and we were there firsthand in 2007, 2008, right? We thought that the 2010 Dodd-Frank Act fixed all that, right? It's supposed to prevent systemic risk and to ban Wall Street bailout. But, you know, smaller banks, you know, they couldn't afford those stress tests. They were left to the discretion of the Fed to conduct those tests. So you could say that they fell off the cracks But if you look at the other side of the pond, the UK, because of Dodd-Frank, they had to post a margin on rather low risk interest rate swaps, and that led to the pension fund crisis there. So I really think that at the heart of this problem, and I think we are all builders here, and that's what we believe in, is that after every crisis, we end up with a spider web of regulations across the globe. You know what? Some of them are even contradictory, right, to each other. So the wishful thinking is that after every crisis, we will learn, right? We will do better. Right. But we forget that really after every new set of regulation, they become the catalyst of the next crisis. And that's what we have seen this time. And also, I mean, you know, I also want to take a more neutral tone, right? You know, the Fed is really an interesting animal. And I really salute to Caitlin here to fight against this beast. But, you know, more neutrally, every single crisis, after every single crisis, Fed is given more power, right? And then this Fed has very, very opaque objective, you know, so-called dual mandate, right? It promote growth to control inflation. Look at New Zealand. It's very clear. The single mandate of New Zealand Central Bank is to keep the inflation between 2.5% to 3%. I think that's much, much better. So coming back to why we are building on Bitcoin, I'm sorry to go about so long because, you know, it just, this crisis, like, another one, right? I think the solution is not regulatory solution. The solution is technology. And Bitcoin is the technology. Blockchain is the technology that is already there to build the financial services. It's immutability, transparency, security, you know, enable the decentralized finance. And that's why we are here to build a financial service on Bitcoin.
So a perfect lead into the next question is can technology really be a solution to this current problem, but for future problems? I mean, again, I'll say it so the three of you don't have to, you know, regulation is just a part of this. And we've seen regulation fail us. We've seen regulation guide us. And we've seen the current environment we're in where it's, what's happening? We don't know. We're not given guidance. We're in a very unsettled, shifting regulatory environment, but at the same time are continually having regulation, or at least the conversation, kind of thrown in our face, but no decisions made. And to a point Caitlin made is, you know, someone like the state of Wyoming is doing great work making policy. You've got the state of Utah, for instance, making great policy, and you've got the state of Texas. You've got states, and then you've got countries like Singapore and Switzerland, others that are making their own. So the question for all three of you, and Akash, we're going to start with you on this one. Can technology, Caitlin, I know you're chomping at the bit at this, but just 1 second, can technology help to save the struggling financial system? And is regulation needed, or is regulation the problem and technology actually takes over here?
Yeah, you know, I think the crypto industry is building piping in parallel right next to the old piping. And at some point, economic activity starts flowing through our pipes. And when that happens, we'll be ready. Kind of like we'll have that COVID moment for Zoom. We'll have that for our industry at some point, where rapid change, Cambrian explosion overnight. But while that's being built, it's a bit unfortunate that the U.S. is taking the stance that it is from a regulatory standpoint with the industry. When you look at places like the Gulf or Switzerland or Singapore or Hong Kong starting to take a more progressive approach. And you're starting to see that reflect in US companies and individuals offshoring. So, you know, you see in our VC business, we're seeing teams, operations, legal wrappers, hiring, even founders individually moving from the US just to find regulatory environments that are easier to work with and that are more progressive. So it's kind of I think it's a big loss for the US, but not a loss for crypto, because the crypto industry is doing its thing. It's following the market. I will say that, you know, while overall there is quite a bit of overreach and there's contradictory messaging from regulators, there are some times where in some cases regulators are pointing to areas of concentrated risk And sometimes that's right. And you know, in the Venn diagram of how crypto sees things and how regulators in the US at least see things, when those overlap, it's great. So you know, a good tangible example is with a lot of these custodial business models in DeFi that are theoretically decentralized, but they're still custodial. Some of those have started to be targets of regulators, and in those cases, DeFi builders agree, right? There's a tangible example of that with you look at the likes of Coinbase, Kraken, or Lido, Rocket Pool for liquid staking tokens. There are projects out there that are trying to fix what regulators have rightfully pointed out, that these are custodial businesses. So I guess just a kind of long story short, just kind of pointing to the fact that there are areas where they overlap, and we just need more consistent guidance from regulators that reflects more of that and less of the hodgepodge of contradictory stuff we've seen in the past.
Yeah, and how does that affect you on the venture side? And when we look at venture capital, I mean, is this affecting the way that you and your team are looking at doing investments here in the US or just in the industry in general with a, again, unsettled, shifting, constantly unknown regulatory environment?
Yeah, you're just seeing founders of early stage projects shifting entirely to more friendly environments. There are a lot of teams out there that are moving their IP and their people, hiring developers in Crypto Valley in Switzerland or Singapore or elsewhere, where they can actually do their business. And it's also a shame for the broader ecosystem. It's a shame for regulators in the US too, because they're not getting that product market fit, you know, to use that same analogy that businesses go through. The regulators aren't getting to do that either. They're not getting the iterations and the cycles with the newcomers in the crypto space. So but by the time these companies have started to catch fire, the US is going to have missed that boat, I think.
Galen, I'm gonna unleash you as we're here at Bitcoin Unleashed. I'm gonna unleash you back to the question originally. You know, can technology be a solution, and you know, does it need regulation to work with it, or is regulation the problem as well?
Well, it's both. But I think what we've seen vis-a-vis the banking industry is that there's been a big move against technology. And this is broader than just crypto, as we were just talking about. It's also fintech. There have been, if you go back, the regulators were signaling last fall that they were going to be moving against fintech. So that's not a complete surprise. What was a surprise was how much they moved against crypto, and it happened over the holiday break. So the first sign of it was on January 3rd, when the three federal banking agencies, again, not the SEC, the banking agencies were leading this. That's where the real problem was always going to be, in my view. And they came out and said, essentially, open, public, permissionless blockchains are too risky. Actually, it wasn't specifically that. Here's what they said. They said open, public, and or decentralized protocols. Hello, what is TCP/IP? What is HTTP? I mean, if you really read what they said, literally, they banned the banks from using the internet. Okay, but at first I thought, okay, well, this is just lawyers who don't know anything about technology writing policy without the tech people at the table. And as time went on, as I saw what they were doing to some of the banks and the fintechs. And frankly, we all read there was a Wall Street Journal article, maybe all of us didn't read it, but I was really interested in what happened over the Silicon Valley Bank weekend. Actually, the Thursday night before it was taken over on Friday by the FDIC, they actually were trying to get the Fed to do something, to run a trade after the wire room had closed at 4 p.m. Eastern. And the Fed said they couldn't do it because they had to run a test trade. I mean, my gosh, you know, that tells you how bad that back-end technology is. And trust me, I'm very familiar with that because we've had to build. And there's a lot that I can go into here, but we won't go into it. But here's the point. The fintechs got so far ahead, and crypto, especially with stablecoins, got even farther ahead of the Fed. And I think it scared the bank regulators. And they watched as something they didn't anticipate, which they should have. One of the things that the bank regulators had been doing stress tests for on liquidity was a 35% withdrawal sudden withdrawal of deposits, that was considered the worst case. Well, heck, with Silicon Valley Bank, it was 25% within the span of a few hours. Okay. And so now everyone woke up and realized, well, with social media and online banking, everything's happening faster. Okay. And now I just saw Lynn Alden tweeted this morning, the new cash levels for small banks, it's up to, I was just eyeballing her chart, somewhere just north of 7%. 7% cash levels when you might have a 25% withdrawal in the span of a few hours. We got a major issue, folks. Houston, we have a problem. And by the way, the large banks, the perception is that they're so much better off. They're not. Their cash levels are only about 10%. Okay, so in a world where money can move that fast, and the back end technology rails are so antiquated, of course, building a parallel system makes sense. And it is fun, back to your question about technology, it is fun to see this industry just go build without permission, because we all know, every one of us knows that anyone can download the Lightning Network on their phones and start actually transacting in fiat currencies, including the US dollar, without permission. Anywhere in the world, all 8 billion people in the world can do that now. It's only a question of how fast and how easy all of you engineers make the user interface. But it's code, folks. The regulators can't stop it. And I think what they're trying to do, again, back to this whole January 3rd thing, where they really trying to push the banks away from using the internet. Now I'm not so sure. In retrospect, maybe that's exactly what they were trying to do, push us back to an analog world.
And which is shocking and breathtaking for, again, what I talked about in my talk just before we all joined. I mean, we've gone through these great innovation cycles for the last 30, almost 40 years now, to then all of a sudden rip it out is kind of questionable, but also a little sad and depressing that we've had such great.
But we're just going to go around them. Yeah,
exactly. I would say you took the words right out of my mouth. So there we go. So we're going to go around them. That said, how do we begin to step away from the traditional finance world, just to give us an encompassing term, and into technology-driven solutions like Bitcoin? We're here talking about building on Bitcoin. We're here talking about decentralized systems. It's great to talk about it, but how do we actually begin that migration? Chenta, let's start over with you.
Sure. And then if I may follow up the discussion you just had with Kate and Akshat, is that I think US is in a very unfortunate regime that, by the way, laws should be passed by Congress, and FDI and CFTC and SEC is supposed to implement those laws. So they should be the one who implement those laws. They are not the one who write the laws. But we are very unfortunate. We have these two very, big figures, in the sense that more ambitious than their mandate, and coming out there and just punching us left and right. So that's just my take about the current regulatory environment. Let's come back, and it's really not commercial, but just look at Alex, right? Alex is a decentralized exchange. It's completely decentralized, and everybody can access it as long as you have internet. It's very, very transparent. It doesn't need clearing houses. I mean, think about the clearing houses. Why do we need a clearing house here? Because the transaction or settlement of, let's say, equity at the moment in traditional finance takes 5 days, right? I mean, within these 5 days, there's so much risk being warehoused in the system that you need to throw all the regulation, all different, intermediary in order to make it safe. Whereas if you come to like Uniswap or Alex, you don't need clearing houses. Just be taken out. You don't need that. It's just much more efficient. The settlement on Bitcoin, people laugh about it, but it's T plus 10 minutes compared with T plus 5 days, right? And second is that, if we come back to the traditional bank lend borrow, you have other type, right? Again, completely decentralized, and give you lend borrow these kind of services. So that's why we are here. We think that technology is just here for us to build a much, much, much safer financial service for everybody.
Akshat, similar question to you. How do we begin this transition? How do we step away from traditional TradFi. How do we step away from that into a technology-driven world, including that of Bitcoin?
Yeah. I mean, I'll tell you how Maelstrom is approaching things. We're the family office of Arthur Hayes, Bitcoin OG, founder of BitMEX. We've just got launched in December 2022, but we've been actively deploying in early stage infrastructure projects. And there's three prongs to our strategy here. Number one, probably first and foremost, is backing projects that are abstracting away complexity, whereby users can get the benefits of blockchain applications without any of the added complexity. I think that's going to be very, very important for our industry to actually create apps that get, you know, the next billion users, or the first billion users. We don't really have the first billion yet. The second area that we're looking at is non-blockchain applications of blockchain tech, just like very, you know, simple stripped down ways to just start to commercialize building blocks of the broader blockchain ecosystem. So a more tangible example of that, we just closed a deal with Balaji Srinivasan in a company called Nox, and they're kind of like a deal.com for hiring, payroll, compliance infrastructure for pseudonymous hiring, and it just uses ZK proofs. So just, you know, it's just taken one piece of the broader technological stack that exists in crypto, and just is focusing on commercializing that in a way that the users don't really know that or care that they're using ZK proofs, but they are beneath the hood. So more stuff like that we'd love to see from developers. And lastly, just anything that promotes genuine decentralization. These single points of failure that have existed, be they centralized exchanges like FTX, or even in bridging, you've got like Nomad and Wormhole and things like that. Those things they're stepping stones, and they blow up because they're not really the final product, and we need to get closer to the final product, which is genuinely decentralized elimination of all single points of failure in these systems, so that when we get our, you know, I use this analogy of Zoom having its COVID remote work moment. When that moment comes and the Cambrian explosion happens, and all of a sudden everyone's looking for an alternative system, we're ready to go. So I think when it comes, it'll come, but we just have to be ready with the tech stack.
It might be here. It might have already happened, and we're getting into that realization. And speaking of single point of failure, Caitlin, you and your team at Custodial Bank have experienced this with the Fed membership application. You and your team have gone through multiple attempts. Again, a single point of failure because it has stopped and prevented you from what you and your team, along with the others in the industry, have mandated as opening up not just a custodial, but also a crypto bank, for lack of a better term right now. Talk to us about why this is happening, why does this continue to happen, and how can it be avoided as well, and just kind of the general situation that you guys have gone through.
Well, they're trying to shut down the US dollar access. And again, this is the problem that we set out to solve. So it was basically retired. And you know, when Wyoming set up this bank, here's what happened. There were 150 groups that tried, and the Wyoming Division of Banking turned them all away because they wouldn't have been credible at the Fed. And so I thought, well, look, I came from the banking world. I'll roll up sleeves and go do this, because I knew this was a way that I could contribute to the Bitcoin ecosystem using my background, having come from the banking world, TradFi world for a long time, and that we could put a credible team together. And we were trying, and we, I mean, obviously the facts speak for themselves. We were making a lot of progress. At the very end, it took 2.5 years, but something changed and abruptly in January. Okay. And then we didn't realize it at the time, but we were the tip of the spear on what turned out to be an all of government massive crackdown on anything related to this industry, including the lawful parts of it, and the teams who actually actively sought regulation by the Fed and or the FDI or the SEC were the ones that actually ended up with enforcement actions, or in our case, outright disparagement of us by the US government. They wanted clearly to send a signal to everyone else, don't bother trying. Now, we've been told, because there are tentacles everywhere, we know exactly what happened in our situation. By the way, the White House was absolutely involved. I still don't understand why the Fed got involved with the White House to do the White House's bidding. This is a political thing. And, again, these agencies are supposed to be independent, but it clearly wasn't in our case. And the interesting question is well, the tentacles I mentioned were that they thought we were going to run away with our tail between our legs, and they did not obviously have that calculation correct. But nonetheless, where we are now, obviously not moving forward with Fed membership because the Fed slammed the door. The question then becomes, what's next for Custodia? I'm a Bitcoiner first by far. And we have the Wyoming bank charter that can do business in most US states, not all. We will obviously have to be specific about that at some point in the future. And because there are laws in the United States where states cannot discriminate against other states' state chartered banks, but there are 50 different regimes, and the details really do matter. And so here's the punchline. We are working on a Bitcoin custodial solution. The interesting thing about it, and I will be the first to say, not your keys, not your coins, don't custody with us. Very similar to the way Kraken operates, right? We'll offer the service and discourage people from using it. And in our case, it's businesses. We're businesses only. But under the Wyoming law, because Wyoming recognized the ethos of Satoshi in saying we should not be forced into a system where everything is counterparty risk. Fiat currencies are issued by a counterparty that might fail. They're called governments. Bitcoin is beautiful for many reasons, one of which is it has no issuer. And there is therefore no counterparty risk. And we don't want financial institutions to have to become counterparties, just like the traditional banking world works and just like the traditional securities world works. And so under Wyoming law, there is what is effectively this. It is the same law, actually, as it's called bailment. Same law as valet parking for your car or valet or a coat check. You legally do not turn over title to your Bitcoin to the Wyoming special purpose depository institution like Custodia if you choose a bailment structure. Ergo, all your bank is a money warehouse that's providing safekeeping services. We've gone back to what banks should be, which is simply money warehouses in the state of Wyoming, and it's only available in the state of Wyoming. Again, it's a nod to the ethos of Bitcoin. There's no reason why you should be forced into a counterparty relationship, a counterparty credit relationship, which is exactly what happens in the traditional world.
Caitlin, thank you very much. Fight on. Excited to see you and the Custodio team win, as I'll put it in my words for you as well. And again, thank you very much, Akashat. Thank you very much as well for joining us. Chente, again, thank you, and congratulations to you and the Alex team on the launch of your Bridge mainnet today, bridging Ethereum and Stacks as well. With that, everyone, while banks are failing, Bitcoin is not. It's stayed true since 2009 and still does today. It's the core of the industry. Thanks, everybody.